Hello friends, this is Singh, broker owner of Supermax Realty, 647-961-2639, or you can reach me at www.supermaxrealty.ca. So friends, in continuation with the financial independence and the video, especially for the millennial demography, I want to make another video because in the morning I was discussing retirement and real estate investment, passive investments with one of the new couples who came to Canada, and they're looking to buy their first property. And they asked me, they said, Jimmy, we make $85,000 per year. Is it possible we can retire in next 15 years and not worry about money? And I'm a big believer, if you plan things, they will work out, but you got to have a plan in place. So I tell them how much you earn is not the deciding factor in achieving the financial freedom. The deciding factor is learning how to save, manage, and invest your money. That is very important because they found that 70% people who win the lotteries, they go bankrupt in next 3 years. And there was a national survey done which says 30%, 31% self-made millionaires, they average 100,000 per year as their income, or maybe less than that. And 1/3 of those self-made millionaires, they actually make less than $100,000 in their entire lives. So, it's a big misconception that people, with social media feel, they have to keep up with that kind of, millionaires drive big, expensive cars. They have to have expensive, bags, expensive, brands. That is not true, because I meet a lot of, people in my last 15 years who invest in real estate. They are mostly very simple people. And if you meet them across the street, you won't even know how much real estate those people own. They're very humble people. And guys, in our life, the three biggest expenses in Canada are the housing, transportation, and food. Third, I like to add, obviously, is the taxes. That is constant. The more you make, the more you pay taxes. Obviously, there's different tax strategies, and you can talk to your accountant, or maybe we can make another video down the line. And this year in 2020, COVID-19 have shown Canadians the risk of making only one stream of income or only one income source. So if you want to financially, feel free and retire early, you have to make, some changes in your lifestyle. You have to cut some, wasteful expenses, and definitely start investing, even with 5,000 down, 20,000 down, or 10,000 down in your bank. It is doable. So in this video, I'm going to just touch a little bit about real estate, but mostly I will be talking about, passive investment, and especially the, stocks, index funds, or, ETFs. I'm going to, touch base how I build my own portfolio. So it will actually, give you a little bit, tip how to move forward. And you're most welcome to obviously leave a comment at my channel, Real Estate Edge with Jimmy Singh, and I can guide you in the right direction. So guys, first thing is, I strongly believe lack of knowledge to invest makes most of the people nervous, because the more knowledge you have, the more confident or more, you feel in that particular field. So about myself, when I came in Canada in early 2000, so I feel, that time I lack knowledge about the system, financial, system in Canada. So I used to spend on average, 15 to 20 hours a week going to libraries or chapters and reading financial books. That time social media was not very prominent, but I used to spend a lot of time reading these books and researching on stocks, mutual funds, real estate. So at the end of the day, once I become comfortable, I start putting my dollar to work, because money is like a servant obedient. So you have to send them out, to capture more soldiers, whether you're putting in dividend stocks or you're putting an ETF. We'll touch base, at the later part of the video. So first thing is how you can do it. You need a mentor, or you need to assemble of, a team of professionals who can guide you, along your journey. But mostly, just remember, you can do everything by yourself. You just need a starting point. First thing is, guys, if you are in early 20s and 30s, start side hustle. When you do side hustle, you can increase your income, because at your job, your boss is paying you fixed amount of money, but there's lots of ways you can make extra monies, especially sitting home, even during COVID. Number one, you can buy and sell stuff on Kijiji, Craigslist, eBay, Amazon. Second thing is, if you're good in social media, you can, go to approach business people and say, I need, can I manage your social media accounts? Or maybe you can learn graphic designing. Or if you're renting an apartment, you can rent a spare room. Or if you're good at certain subjects like mathematics, science, French, you can, give people tuitions. Or you can do babysitting. If you're good in cooking, you can, do a tiffin service. Or you can walk a dog, clean the house. Doesn't matter. Like if I were young, I have not I don't have 2 pennies to rub. I will do all these things myself to, get ahead in life, because I don't want to depend when I'm retired on my kids or the government to feed me. That is very important for me, to be self-reliant. Second thing is, earn money or to create passive investment so they can pay for your lifestyle. As I said, it can be real estate, it can be stocks. And when you get more savvy, you can, draw money from your RSP and just be a bank and lend people as a second mortgages. Maybe we can make a video down the line. So if lot many people, want me to make it, just leave your comments and I can make a video how as a savvy investor you can take money from your retirement account and RSP and lend like a bank as a private second mortgage locally. Other thing I want to share is the main thing I feel, especially for the millennials, the younger generation, is they have a burden of caring for their young families. At the same time, they are responsible for their aging parents. The challenge, friends, is these days, with medicine and everything, everybody is living longer. So their parents are going to live till 80s, 90s, maybe, till 100. And they will inherit their parents' wealth way later in their life. So basically, by that time, their parents will give them wealth. They'll be in their 50s, 60s. Most of the life would be done, right? Half of the life. And 50% of the millennials I meet and the first time buyers I meet, they always doubt that they will ever own a home in Greater Toronto area, Golden Horseshoe, with the rising house prices. That is their number one concern. One thing, guys, in your control, I tell everybody, is everyone can make choices how to spend their money and how to tackle their expenses and how to automate investments. That is very, very important. So whether you're renting a home or looking to buy your first home, always find a way to invest in your retirement. So every dollar you make from your paycheck, make sure you take 20, 30, 40, doesn't matter. I know it's very hard to do in certain parts of expensive cities, but if you want to, be financially independent and retire early, you need to throw a lot of money into your savings and invest that money. And this year in 2020, Manual Life Financial did a survey. They want to see how COVID-19 have impacted the financial health of Canadians. And they found out that 1 in 3 Canadian is not financially prepared for pandemic. 46% people said these debts or visa loans and everything is impacting their mental health. And 2/3 of the people worry about money. And 69% people who were surveyed, they said they have no plan, how they're gonna, live in their retirement. So that is very important, guys, right? So improve your financial education. That is key. And at the end of the day, put your dollar to work. That's very important. Money sitting idly in your bank is not doing much in the low interest rate. So if you haven't watched my previous video about millennials and how they can go ahead in life, watch that video as well. Because what happens is, if you get retired, Typically your retirement fund, let's say RRSP, you have to start drawing money, and the rule of thumb in financial industry is 4% rule. So what 4% rule says is, let's say you have $500,000 sitting in your retirement, and your the investment is yielding or giving you 4% return. So every year you can draw $20,000 per year. And let's say if your profit in that account or the yield is 9%, you can draw $40,000 per year during your retirement. And obviously, if your money is in different accounts which are not sheltered, apart from RRSP or TFSA, you can expect to pay 25 to 30% tax on those tools. So ask yourself this tough question, guys. Am I going to have enough money to take care of myself when I retire and not burden my children? So that is a question, that is a kind of a North Star. You should focus, what is the number I want to live? Do you need $1 million to retire? It seems like a big number. You need 2 millions, you need 3 million, and then break it down. When you have a monthly budget, you see how much I'm spending on my food, how much I'm going to spend on my shelter. Do I really need 2 cars? Do I need 1 car? Can I get rid of the car? Because there was a research done, many years ago. They said average Canadians spend in their lifetime close to $500,000 on their cars. Whether you're buying cars, fixing cars, you are giving insurance or maintenance. So that is thing you have to understand how these things pan out in the long term. Let's talk about now passive investment. So I'm not going to discuss much in this video about real estate, because everybody knows real estate can be passive investment if you are buying pre-construction, or you're buying newer homes and then after 1 year you want to sell it, or if you want to hire a property manager. Because in our brokerage, Supermax Realty, most of the investors who buy with us, we manage their properties. So it's kind of a passive investment, right? But this video purpose, I'm going to talk only for millennials who are not ready to buy real estate, but they want to save and learn what are the other tools. So what you guys want to do is, you want to invest in other asset class. It's called index funds or ETFs. So these are not, guys, stocks. Like stocks can be of any company, like McDonald's, Starbucks. So pretty much you go open your trading account. It can be your self-directed RSP, or you can open your TFSA account. Just make sure certain categories like American stocks, you should be better off putting in your RSP, not in TFSA account, because they are taxed differently. And then you have to sign a form. Bank will tell you which form it is. So there's less deductions from US side. So first thing is, what is an index fund? So guys, index fund is a type of mutual fund with a low fee, designed to track a specific stock market index. So it can be, let's say, US stock market. It can be S&P 500 USA stocks, right? So all the 500 companies at the US stock, they track, and then basically your return in directly proportional to that. So if you're in Toronto, so you can track S&P TSX. TS is Toronto Stock Exchange. So whatever the companies they are making return, you'll actually make that kind of return. Other index people follow is called NASDAQ. Is again American, where there's a lot of tech companies, 3,000 of them, and depending on the return, you will get similar kind of return. And if you want to track 30 top large American companies, you can buy Dow Jones Industrial. So that is also very good. And versus ETF, I invest a lot in ETFs as well. So ETF actually is a basket of security like stocks that you can buy or sell anytime during the day, and they can track a specific industry or a commodity. For example, in my kids' RSP, I have a self-directed RSP because I manage my own money. So even during this pandemic, let's say in March, I picked up a couple of good ETFs. I can give you their ticker names. You can Google and see how they're doing. So when the COVID happened, I was like, people are stuck home. How they gonna enjoy their life? So I see everybody's glued to their cell phones. So I figure out people are playing video games. Let me find a ETF which focus on the video gaming companies, or the companies that make chips that go in the cell phones. So one ETF which I bought was ESPO. You can Google it. And I bought in March, and right now I checked my account early morning today, which is end of November right now, 2020. That PO ETF is up 70%, 70. So what happened is that time I have $25,000 sitting there. I took 3,000, 3,000, 3,000 and bought different ones to diversify it. Another one I picked was XAR. It's also American ETF. It deals with specific industry, aerospace and defense. That time I feel global environment was very volatile and everybody wants defense systems or aeroplanes, right? So that ETF I checked in the morning since March, April, it's up 31% in my account. And the other ETF which I picked is called PSJ. That has bunch of software companies all in North America, and that ETF is up 50%. And then another ETF which I pick is called MILN. Same time I bought 3,000 worth of that. It is up in the morning, I checked 62%, and I have no intention of selling them. So these are all in my RRSP, that is my retirement account. Obviously there's lots more, but I just want to touch base how these ETFs are theme based. You can pick an industry which you have understanding. You can buy biotech, you can buy which are more volatile. You can buy medicine. So there's bunch of different websites. Morningstar is one of them. USA Today is one of them. They have nice graphs there. They can show history for last 10 years, 15 years. So that is something you can keep in mind. And for my kids, self-directed RESP, because I manage my kids' own investment. I don't trust any advisors because I do a lot of research. Before I do anything, it's a good idea to, if you trust somebody, go with that. But I manage my own money. So for my kids, RESP, because they are young, they eventually will go to university. I bought bunch of, Canadian stocks, because in that account, you can only buy Canadian. If you buy American, you have to pay a lot of taxes on it. So I buy a bunch of, dividend ETFs for top, like telecom, utility, REITs. So they have like CDZ dividend kind of thing. And then obviously there's a lot of tech companies, because my kids are going to retire go to university in 15 to 18 years. So they have long time. So I bought high growth tech ETFs. So what you want to do is, guys, when you study or Google or research these two ETFs or index funds, check the companies who are offering it. Typically the big companies are Vanguard, iShares. So you just compare how much fee they are charging, because there's a lot of commission you have to pay on these things, but you have to see MER ratio. What is that? It's called management expense ratio. For example, if you're buying any ETF, if it says 0.55% MER, what it means is for every $1,000 that you invest in that ETF, the fee is $5.50. And that if you also have to see, is the fund actively managed? So if the turnover says 19%, 20%, it means the more they manage actively, the more fee the financial, people in that, ETF or the provider is going to charge you. So it is very, very important, guys. And research have shown again and again that passive investment into ETF or index funds beat active managed funds by advisors in the financial industry over long term, because they always try to time the market and pick the hot stock, which most of the advisors fails miserably. There's a research, you can Google and find that, right? So the thing is that in your life you're busy with your work, your family, your job, so you want to put on autopilot. So what I do is I set up quarterly or monthly deduction from my account. So certain portion goes into that investment, and then I buy certain ETFs. If I have like 50 shares, I buy 10 more, 15 more, 20 more. So that way I grow and dollar cost average my purchase. So that is very, very important, because in Canada has the highest management expense ratio fee in all the developed countries. So it is rated D, right? So if you have an account like RSP, you can buy American ETFs. Their fee is very, very less, and they have top companies all across the globe. So you can buy US companies, you can buy Chinese company. I have some Chinese ETFs as well. You can invest in Asia, you can invest in Europe, you can invest in Middle East. So there's a lot of different, things you can buy. You can invest in, pharmaceuticals. So those are all things, guys, you can start even with $5,000 to $10,000. Just make sure whatever money comes to you every month, try to live, frugally. So basically, instead of paying $3,000 in rent in an apartment, move to a smaller city. You know what I mean? Cut your expenses in half. If you don't need a car, get rid of the car. Take a bus pass, or you don't need to buy a brand new car. I still buy resale cars, 2 or 3, 4 year old. I pay cash for them. I have no loans on them. And because these things depreciate like crazy. So I rather buy a depreciated car, and whatever money I save, put in my retirement, right? So you have to make wise decisions, guys, in life. You can't blame other people, right? So just remember one thing. No one cares about your finances than you do, right? So till next time, guys, to your success. I hope you like the video. I'll keep pumping more videos, for financial education, because I strongly feel the young generation need this education, especially the millennials and the young population coming out of our universities. They need to, understand how the money works, and they take their destiny in their own hand and be responsible about that, right? God bless. If you like the video, give it a thumbs up. If you want me to discuss any other topic or elaborate, leave your kind comments. I will respond back. God bless. Thank you very much.